Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the July edition of Digging into the BI. This is where members from the Maryland, DC regional chapter get together and look at the latest issue of Digging into BI, the members only magazine for long-term fundamental investors. And here are the four stocks we're going to be looking at tonight. It's going to be Middleby, CVS, UnitedHealth Group, and Palo Alto Networks. Thanks for joining us. Cheryl, let's go to the next slide. So this is our standard disclaimer. We're doing these for educational purposes. We believe, as Better Investing does, that investors should conduct their own review and analysis of a company. If we mention any of these securities, we may or may not own them on our personal portfolio. We try to alert you, but sometimes we miss on that. And keep in mind that if we're showing you any particular websites and stuff, we're not endorsing, nor is BI endorsing or promoting any of those websites, products, or services. This is being recorded and it will go up on our YouTube channel, hopefully later on tonight or tomorrow morning. Next slide, please. So here we are. This is who Better Investing is. Again, most of the people I see right away in the audience are members of Better Investing, but since this goes up on the World Wide Web and you may not know who we are part of Better Investing. And on the top of every slide, you'll see the URL that will show you our location, betterinvesting.org. If you want to know more about us, if you are here now, you'll be able to get the handouts, and anything with a blue underline is a hyperlink that you'll be able to go to be able to see more about our organization. And we are investment education. We focus on long-term fundamental investing, and all of the people that are speaking today are volunteers from either Maryland, DC, or Virginia. Next slide. So we also, like I said, have a YouTube channel. We have just crossed over 150. Well, let's see if we can get up to 200 subscribers. That is clearly not at the level of some of the people up on YouTube, but you can find us at YouTube at Digging Into BI. You can just search under Digging Into BI in YouTube and you will find us. And you will see all of our webinars for about the last year and a half, maybe 2 years are up there. All we ask for this free program and for those free webinars is to go ahead and like the video, share it with friends, and subscribe. That's how the algorithm works at YouTube. And all of the webinars that we put up there are organized into what are called chapters. That's that blue box over on the right-hand side. Chapters are basically just to break up where the next stock that we're talking about. So if you don't want to listen to all four stocks later on, and you saw one that you like, go ahead and do that. Just a moment. Sorry about that. Had a little scratch in my throat. So that's how the chapters are organized, and that's standard throughout YouTube. So anyway, let's go to our next slide. And if you are new to this and you don't know how to do everything, if you have any audio problems, you can reach out to us in the chat box, and we will try to communicate with you. But again, there is a 4-minute video on sort of getting started. We haven't had this problem in several months, but this is also where you can get the handouts. If you look at where that green arrow is down at the bottom of the 3 arrows, that's where you're going to have the 4 completed SSGs plus this slide deck for tonight. And again, you can share the slide deck and the SSGs with anyone in your club, in your community, someone who's looking to join your club, to just show them a little bit about what we do in Better Investing. We're not the be-all and end-all, but we do try to be able to follow the methodology that has been given to us by Better Investing. Next slide. So why do we do this? Well, again, and there's a hyperlink. If you do not know anything about Better Investing, you can get a free 90-day trial. That's that blue underline there. But what we do is we focus on learning, helping beginners or people that are uncertain with their judgments how to use the stock selection guide, the SSG, or the PERT report. Sometimes we use that. We're trying to be able to show you best practices for a long-term fundamental investor. And also, this is a joint program that, like I said at the beginning, from the 2 Mid-Atlantic chapters, the Maryland chapter and the DC regional chapter. We do have a couple model clubs. We'll talk about that in just a moment, that you can be able to learn about it. And then we also will be able to promote the Club Connect program. Cheryl will tell you about this. This is a new way of what used to be Visit a Club program, but it's a way for us to connect with people in Maryland, DC, and Virginia. Again, if you're not from one of those three jurisdictions, we're welcome to have you. You do not have to be a member of Better Investing to attend this. We are doing this because we like to be able to show long-term fundamental investors, and we like to be able to build a community in the 2 states in the District of Columbia. Next slide, please. So in just over an hour, we're going to do 4 stocks. It is kind of fast, maybe faster than what you would normally do in your club, but we always look at the stock to study and the undervalued feature that are in the magazines. Those are for member onlys. And then we get 2 additional presentations that come from, they have to be found from either the BI website, the magazine, so it can be also maybe personal experience, but there's first cut, screening tools, ticker heat map, top 100s, a whole range of things. It can also be something that you've been looking at in your own club and you want to be able to present it here. All of those are welcome. Next slide. So again, this is a place that you can be able to find stuff in advance. The 2 stocks that are featured tonight, Middleby and the UnitedHealth Group, were announced back in mid-April, and you can see the red circle there. You do not have to be a member of Better Investing to see these announcements, so you can share this with other people inside your community. You can already see that next month they already have FedEx and Gap listed for both the stock to study and the undervalued feature. Next slide. So if you are a member, make sure to sign up for future announcements. And the way to do it is you go into that upper right-hand corner. If you see where the red circle is in the screen capture, click on My Account. It will take you over to the left-hand side where I have the home My Account. And you'll see the green circle I have. That's the email and product subscription information. That's the green circle. We lost us, and we'll come back. One more slide forward, I think. One more. There we go. The green circle email, we did it again. Back up. I don't know why anyway, as you can tell, we're not professionals. We're doing this for fun. Anyway, email and product subscription information is a green circle over there. And if you do that, it will open up over on the right-hand side, and that's where you can be able to sign up for stuff. Where that arrow is, that's where you can get the local chapter news. But before you do that, up at the top, it says BI Weekly Newsletter. I didn't mark it. Come down a little bit. It's the first one down a little bit more. It says BI Weekly Newsletter. That's where you can sign up to get stuff from headquarters. Next slide. So this is what the weekly newsletter looks like. It's for members only, but they highlight educational things that are going on at the national level, programs that we call Ticker Talk, Stock Up, First Cut reports, Stock Ideas. It usually comes out the close of business on Thursday. If you signed up for it and you haven't gotten it, I would check your spam filter. But we do have a couple things that are coming on up, at least by we mean headquarters, just outside of Detroit, where they're going to be able to showing you ways to be able to export or explore the My Studies part of the online tools. That's that sort of orange and black arrow over there. And then also the First Cut reports is a great place to get ideas from other people. That's the blue arrow. So go ahead and take a look at things there. Next slide. We're also up on Facebook and the like. We usually promote this. I didn't get it up this time. I was kind of lazy. But again, with Facebook page, you do not have to be a BI member. It's a way to be able to reach out to other people and share it in the community. But go ahead and use that as a location. And again, you can share that with other people that you're thinking of bringing to your own club. Next slide. Cheryl, tell us what's going on in the DC chapter.
All right, we're going to be having our annual planning meeting this month. It's Saturday, the 13th of July. We'll start about 9:30 a.m. and hopefully end about 1:30 p.m. We'll give you a chance to break for lunch wherever you are and then dig back into it. And we'll be looking at the events and trying to pick dates for things for the entire next 12 months. So please come if you can. This is virtual, and so I will be sending out an email soon, and we'll also be correcting the events page to put the correct link on there rather than that contact@dc.betterinvesting.net. Back to you, Kevin. Why am I not moving here? There we go. Okay, this is for the Maryland chapter, a Happy Destiny Investment Club. Susan, can you tell us about Happy Destiny?
Yes, good evening, everyone. Happy Destiny was started in 2001 with 7 partners, and we meet the third Friday of every month unless it's a major holiday. Then we either go 1 week early or 1 week late. We start usually at 6:30 and we end by 9. We have members spread out through Maryland, DC, and Virginia, and currently we are an online club since the pandemic. We have usually an education session every month, and we do stock studies every month, as well as review our portfolio. And you can reach one of the members by emailing at diggin.into.bi@gmail.com. Just put the subject, Happy Destiny Investment Club.
All right, thank you, Susan.
Thank you.
And all right, here we have
here we go. And so I'm also a part of, yeah, there we are. I'm part of Montgomery County Model Investment Club. That's a summer social that we do with another club called Pinnacle, because one of our members is in both of them. But we're a 5-member club, kind of small, so we're obviously looking for people. We meet on the 3rd Wednesday of the month from 7 to 9. There's the link to go to meeting for us. You don't have to be in the area, but we would like you to be in the area to be a club member. We are going to be looking at educationally the investment policy statement. We've been starting on it. We're going to be going through the next part of it. And then Stride Inc. is going to be our stock study. So if you're interested in that, join us on the 3rd Wednesday, which is July 17th. Thank you. And to you, Cheryl, and tell us about your club.
Yes, besides belonging to Happy Destiny with Kevin and Susan, I also belong to the Model Investment Club of Northern Virginia, otherwise known as McNova. We started in 2008, currently have 14 partners. Our next meeting is on Tuesday. It's the 2nd Tuesday in the month, June 9th. I'm sorry, that should be July 9th. And it runs from 7 p.m. to 9 p.m. We're also an online club, and there is the link to join us on that 2nd Tuesday in the month. And we're going to be looking for education of what's new in the SSG online tools. And our stock to study will be NVIDIA. And there is the point of contact email. So if you have any questions, you can send an email there. Just put in the subject line what it's about, and we'll be glad to talk to you about it. And also, I was also going to talk to you about Club Connect. Now, as Kevin pointed out, they used to have a program, and they've changed it a bit and made it more updated and also more interactive in terms of helping people who are individual investors who are looking to join a club, as well as clubs that are looking for members. And so it will be more proactive and hook these people up and let them discuss with each other and to see whether they feel that there is a connection there. And so please look into that Club Connect. You can get to it by clicking on investment clubs and then the green arrows that come down, go to Club Connect, click on that, and you will have a form that you need to fill out in order to be added to the listing.
And since the program is called Digging into the BI, we like to be able to tell you a little bit about the magazine itself and feature some of the things that are there. This month is sort of one of the 2 dual months, so June and July. Most of this stuff came out in late May. But again, I know a lot of us like to wait for the paper version that comes through our mailbox. My last one, it looked like a dog chewed it before it got into my mailbox. I know that's never happened to anyone else. But you can also get it electronically through, that you can see on your computer, your laptop, tablet, smartphone. The stuff over on the left-hand side actually came from my phone. So you can look at it there if you want to, or you can also look at it just like you are here. If you're on the BI website and you're signing in, you can be able to look at the magazine there, and it comes a lot sooner than it does through the mail. Next slide. So one of the other things with the featured stocks, there's additional information. And if you see over on the left-hand side, the red arrow that says analyst reports and other resources, when in the magazine they talk about additional resources, it's going to be right there. So if you click on it, if you want to know how to be able to reach and get the magazine for mobile devices, it's the green arrow there. It's a slightly different sign-in than what you have for your traditional one. But click on that and we'll sort of walk you through it to be able to take care of it. And if not, just reach out to headquarters and they'll take care of it since they're paid the big bucks for that stuff. Next slide. So since we did talk about, we like to look at one of the articles, I found this one quite interesting. They called it the column yield signs. I don't know if it's relatively new, but the article is about first-time dividend payers being something to take a look at. The author is one of the people over at Provident. Provident's the ones that do the repair shop and several other columns that are there. They also select the stocks that are part of the investor advisory service. But, if you're looking for new ones to do it, the recommendation is to consider maybe stocks that are just starting to pay a dividend. And they pointed out 3 of them that are just starting to pay dividends themselves. Booking, Meta, and I forget what the third one, I think it was T-Mobile. So those may be something to take a look at. But overall, the article, if you're looking for stuff to be able to, if you want to transition from growth to maybe some income, something like a first-time dividend payers may be something to take a look at. Next slide. And so here are also some of the events that are coming on up. Some of them, actually looks like most of them, all of them were done last month. So there really wasn't much I could find for July that was already up. Maybe I didn't look at it that closely. But again, on page 51, you can be able to see all the different events. Maybe there's something I missed for this next, for the rest of July and see what's taking a look. But some of these other chapters like South Florida do a lot of regular things. I know Heart of Illinois does stuff usually during the middle of the week too. So go ahead and take a look at those things. Next slide. All right, we're done with all the intro stuff. So now we're going to do what everyone has come here for, and that's to take a look at the stocks. So the first 2 stocks we're going to be looking at in the core SSG, and we're going to start with Brian Koenig, who's going to be able to talk about Middleby, the stock to study, and then Miriam Al-Kazami is going to, a first-timer, will be actually looking at CVS, which she heard about when she was at Bink, and that's where we met her. So first to you, Brian, and take it away.
Thanks, Kevin. Good evening, all. I'm Brian Koenig. I'm Maryland Chapter Director and an Associate Director of the Better Investing Volunteer Advisory Board, along with being a member of the Volunteer Training Committee and Education Committee. Sounds like I'm on too many committees, but that's all right. Next slide, please. Tonight we're going to be talking about Middleby Corporation. MIDD is the symbol. It's in the BI magazine, starting on page 26 in the for the July issue. It's an excellent. I'm going to not even do the highlights of it because there's so much information in there. So I recommend that you go ahead and go back and read it. Next slide. It was started in 1888 by a couple people in Chicago making custom portable ovens. Over the period of time, they got into the over-the-counter stock in 1988. 9 years later, they started an IPO and got on the NASDAQ exchange and have been there since. Next slide. Here's the company information. It's engaged in designing, manufacturing, marketing, distribution of a line of food service. One of the things they make along with ovens and refrigerators is soft-serve ice cream machine. And the sector is industrials. The specialty industrial machinery is the industry. When we did the study, it was $122.87 for the price. The fiscal year ended 12/23. It's a medium-sized company with sales a little over $4 billion and Morningstar Financial Health of B. Next slide. Some of the products and services that it talked about, the quick serve food outlets and stores, supermarkets, stadiums, prisons, military bases, and other institutions that do that. The residential business does specialty shops, designers in that, and each one of those can have a soft serve ice cream machine. Maintains a global reach with 44 manufacturers in the United States, 35 in 14 other countries. Next slide. Here's the revenue by segment. The largest segment is commercial with 62%, food processing 20%, residential 18%. The revenue by region, US and Canada, the 70%, Europe, Mideast, the 19%, and Asia and Latin America, the last 11%. Next slide. So let's get started. The tab 1, step 1, tab 1, step 3 in the analyzing growth in the core SSG. The green line is sales. The blue line is earnings per share. And you can see that historically, we moved 2020, that data, and the earnings per share in 2015 was a bit of an outlier. So with that, ended up with a growth for earnings per share of 10.5% and of sales and 9.5 for earnings per share. Next slide. Here is the evaluate management, the tab 2, and then the steps 1 through 4. 1 and 2, you'd like to have them steady and increasing around 15% or a little bit better. The dark line is Middleby, the magenta line is a peer group. They've just gone through the last few years some hard times with the economy not doing well. As you can see there, they're not really that straight. The total debt, the majority of growth has been through strategic acquisitions. And did I mention that one of those acquisitions might be soft serve ice cream manufacturer? But if you look at the debt to capital, while it increased up to 2018, management's done a really good job of controlling it. And in 23 made a very distinct drop in the debt to capital. Next slide. So tab 3, step 1 is going to talk about forecast sales and earnings. So forecast sales, as we talked about before, it was growing at 10.5%. 22 to 23, it kind of leveled out. In the first quarter in FY24, you see that it's still going down. So I thought that the 10.5 would be too high, so I selected the 8% to use, and the 8% growth will change a little over 4 billion to almost 6 billion in sales in 5 years. Next slide. So for the forecast earnings, I followed a similar logic. While it was up to 9.5%, the last few data points show that it's decreasing. For that, I decided not to go higher than sales, so I did 8% for that. And if you take an 8% growth in the $7.41 of current earnings per share, it will grow to $10.89 in 5 years. Next slide. So for tab 4, what we're going to do is assess risk and reward. Here we have the historic high PE. We look at the last 5 years, and for consistency, I deleted 2020 and 2022 as outliers, which came out with a high PE average of 22.5. If you look down below there, the 3 of them that are listed there are 22.5 for the average high. Just the average is 18.8. Current was 17. I thought 17 would be a little bit low. I didn't want to go with 22. It's quite a difference there. So what I did was I went halfway between the 18.8 and the 17 and came up with 18. So I multiplied 18 times the $10.89 from the front side, came out with a forecast high price of about $196. Next slide. Okay, again, looking at the low PE and removing 2020 and 2022, came out with 15% for the average of the last 5 years. Next slide. So here, if I look at the top one where it says the average, if I took the average of 15 and multiply it by the trailing 12 months of 7.18, that came out to $107.07 or 70 cents. However, the current price of 122 is only 13% above that price. So I didn't think that was enough distance for the low price. Might skew it. I looked at 80% of $98.30. I thought that would be a much better choice. So I selected $99 down on the lower left as my forecast low price. Next slide. So here's a summary of it. The forecast high price, 196 on the left. The low price, 99 on the lower left. The breaks, 172 for the hold to sell, and 123.3 from the buy to the hold. With 122.90 is the current price. Calculations there on the right show that it's a 3.1 to 1 upside downside ratio. Next slide.
You have 5 minutes.
Okay, here we have the payout. There's no dividends, so there's no yield to consider. So to determine the 5-year potential compound total return using the forecast high PE came out to be 9.8%. So that would be the results there for the compound growth over the next 5 years. Next slide. So in conclusion, Middleby is a medium-sized growth company, well managed over some tough times. Hopefully things will get better and soon. Currently in the buy zone, just barely. You can see the closed values there. It's trading at a relative strength of 35. We'll see that in just a second. The current PE of 17.1 is 9% undervalued. No dividend. Would consider adding it to the portfolio position or start a dollar cost averaging if the sector and or size would improve my portfolio, and if one of the companies made soft serve ice cream machines. Next slide. This is something that I am trying to get people to look at. This is the big chart under the research tab on the right, top right of the SSG. You can see the last 5 years. It started off at about $140, which is a little bit above where it is now. But if one were going to watch this, it might be a good dollar cost average into, and if it gets too high, there are 2 channels. One that started in just before 2021 and went right into the beginning of 2022 from 160 to 200. And then at the 2022, it started to drop and set up another channel between 120 and 160. So that $40 is 33% of the low price of 120. So that you can get some reasonable growth there. The arrow shows that, to me, it looks like the last few numbers there indicate that it's leveling out and probably may not go below 120. Down at the bottom, the 50 shows that that's the relative strength index. And what that shows is that it's 34.8, indicating that it's an oversold position. So that's why when we're going to add it to their portfolio, now might be a good time to look at it and maybe start the dollar cost average. Next slide. Thank you very much.
You went through those mighty quick. But anyway, good. So next up is going to be Miriam Al-Kazami. I met her at Bink, and that's where she got this idea. And you're also going to be our 35th different presenter since we started this almost 4 years ago. So Miriam, take it away and tell us all about CVS.
All right, thank you very much. It's my first time doing this, so please jump in if I make any mistakes, okay? So I'm sure everyone knows what CVS is. Next slide, please. What you might not know is that they can deliver pharmacy prescriptions to you by mail. They have drive-throughs. They also, sell things. They're a retailer. But increasingly, they have the Minute Clinic, which works with Aetna, an insurance company they bought in 2018. To provide all kinds of health screenings. They also do in-home care and evaluations. So because of what they do, they compete with online pharmacies, including Amazon. They compete with other pharmacies as well as other retailers and insurance companies. So it's kind of unique in that it has several different competitors. Next slide, please. Thank you. WBA is Walgreens, Boots Alliance, CVS, Rite Aid, United Health, and Cigna. These are some of the competitors. Just wanted to show kind of the stocks. CVS doesn't seem to, the stock prices, CVS doesn't seem to stick out much. Next slide, please. So when you look at their sales, you'll notice there's a gap around 2018, or no, wait, the sales is the green line. It's relatively flat, but the earnings was impacted in 2018. They bought Aetna. So I think that's probably what happened. Next slide, please. And here is some of the pre-tax profits, about 3%, give or take, for the last 5 years. Next slide, please. Return on equity, the average is 9.7 for the last 5 years. Next slide, please. The debt to capital is a little bit high. At the Better Investing Convention, I learned that 33 is kind of what you should be looking for, or under 33. So this is kind of high, but you can also see starting in 2014, it wasn't that high, and it increased significantly when they bought Aetna for $69 million. So that's something to keep in mind. Next slide, please. This past week actually was really interesting to be doing this because you may have seen the newspapers, Walgreens, they decided to close a whole bunch of stores across the United States. And a lot of the headlines included CVS and Rite Aid in them. And so in looking at some of these articles, I found out that CVS had closed a couple hundred stores between 2018 and 2020, and that they had announced that they wanted to close more in 2021. I wasn't able to see if they actually delivered on that, but there's a lot of stuff that's contributing to this. I guess during the pandemic, you know, our lives changed, and as people started to go back shopping, people's behaviors were strange. There was a lot of theft. I don't know, those of you in Maryland, if you are part of the, you know, your CVSs might have a lock, right? You can't even get a drink anymore because of crime. And one of the ways that, or one of the reasons that Walgreens didn't do as well as CVS, from what I've been reading, is that Walgreens did not have, what is it called, like a PBM, pharmacy benefits manager. So what they do is they get rebates from pharmaceutical manufacturers to help transactions, basically. So CVS did that, but Walgreens didn't, and so that cut from their profit margins. So that was really interesting to me because I wanted to figure out exactly why, you know, would investing in CVS be a waste, right? And my findings are that maybe I shouldn't be too worried. Next slide, please. So I was starting to look at, okay, so the way that CVS is positioned is that it competes with many different kinds of businesses, and they are constantly innovating. It was really interesting to see. I think around last year in the summer, I had looked up CVS to see if they were doing any kind of interesting research. And at the time, there was the, you know, a lot of like the Surgeon General last summer mentioned mental health crisis, loneliness epidemic. And so they were focusing on trying to get technologies to help fill that gap. And then this year, there were lots of initiatives. You know, government sometimes funds some of these things, so it's smart for them to be working on it and publicizing their work. But there's Jill Biden has the Women's Health Initiative that they responded to. And beyond that, they're trying to use AI to cut costs of the administrative process in healthcare. You know, there's a lot of paperwork. They were also working on basically like developing like, new solutions using technology for things like autism, right? So it's kind of cool because they're not just providing care, they're not just filling prescriptions, they're actually coming up with like new solutions to old problems. So next slide, please. I took a look at their investor presentations, and if you look at only the numbers, I guess in a year, they didn't seem to, and if you look at the income, 2.96 in 2024 first quarter versus 4.37, it wasn't extremely impressive. That's where I was just starting to, like, you know, it's definitely performed better, I guess, in the past, I feel like. And you can see they have all these different points related to the prescriptions or repurchase transactions. So next slide, please. If you look at this is just comparing, I think, the last 2 quarters. It's a little bit, it's kind of interesting. You learn about, they have the Caremark True Cost and Cost Advantage. They're trying to develop these pharmacy models. I feel like you see a little bit more detail about what they're focusing on and what advances they're making their business in this time period. But again, the numbers, at least from a cursory glance, didn't seem like they were performing in a really amazing way since February. Next slide, please. So this is some of the data from Value Line that were useful in forming the next slide. So next slide, please. So for this, actually, I got to thank Kevin for this, helping me figure out the high PE forecast. It was 15.3. So what we did was we looked at 2019 to 2023, took out an outlier. That average is the one that we used. And we picked 9 for EPS forecast because Value Line had suggested could go up to 10, but there were there was other reasons why we didn't pick 10. So next slide, please. For the low PE, we kind of did something similar where we wanted to make sure that the price was less than the current price, and so we chose a 8.0. Next slide, please. So that brings us to upside downside ratio of 5.8 to 1. It's at a buy zone between 45.5 to, I think, like something in the $60 range, 60 something dollar range. And it would be, the highest possible forecast would be 137.7. So next slide, please. Yeah, there it is. That's the range, 45.5 to 68.6. And then the hold would be in between 68.6 to 115 almost. Next slide, please. One of the things that CVS offers, though, is that it offers a dividend, and it has offered a dividend regularly, I think, for quite a bit of time. The yield rate is 2.4, so that's the percent of money that they give you out of the stock price. And because of that, you can see that you're making more than just the appreciation of the stock price. You're also making some of the dividends that they give you. Next slide, please. So I think this is from Morningstar, maybe, or I checked a bunch of different references. Right now, I don't remember this exact one. I apologize for that. But I checked to see how much the dividend was every year, and it seems to be increasing, which might be a good sign. And at least I was encouraged by this, right? So next slide, please.
I added this one for you.
Okay, I guess I forgot to include a conclusion. But it's kind of a very interesting company because it's a large company, but it's still growing. It's really like kind of like integrated, like there's vertical integration with health insurance. There's all kinds of it hits on every part of the healthcare market, right? Whether by creating AI to figure out administrative procedures to you know, pharmacy prescription stuff. Like it just does a lot in home care for elder adults. So yeah, it's a buy up to 68.6, which right now the price is about 59. And so I guess that's all I can say, right? If you have any questions, you can, I don't know, ask, save them till the end. Kevin will know all the answers. Thank you all very much.
I don't know about that. But again, Miriam, I mean, you just were you were in what, the beginner's class at Bink, is that right?
Yeah.
Yeah. Ken Kavula said there's someone in your area, Kevin, that was looking to be part of the chapter, and that turned out to be Miriam. And so I see a lot of people in the audience that are regular attendees, but Miriam's like, yeah, I'll be willing to do a presentation. So she's throwing the gauntlet down, and all of you regulars that are sitting in the audience, time to step up and do a presentation. If you can do it as well as Miriam did for her first time out, that's very, very good, very impressive. So gauntlet's been thrown. Let's see who will respond. Anyway, thank you very much. And now let's go to our next presentations. The next two are going to be an SSG Plus. And so we're going to have Susan who will talk to us about UnitedHealth Group. And then afterwards, we're going to bring it on home with Ed Rodriguez, who's going to talk about Palo Alto Networks. So let's go on and let's go over to Susan and tell us about.
Susan, you want to unmute so you can tell us about UnitedHealth?
Can you hear me?
Can hear you now.
Okay, good afternoon, everyone, or good evening. I'm going to talk to you all tonight about UnitedHealth Group, ticker symbol UNH. It is the BI undervalued feature scheduled for July 2024, which we started today. Next slide, please. Okay, so the UnitedHealth Group is one of the largest, if not the largest, managed healthcare company. It has grown consistently over the past 10 years, as you will see a little later on by the SSG. Okay, the most recent hiccup that we have is one of the few blemishes that's shown on the SSG for this company. So it has grown sales of about 10% and earnings at about 14%. Pre-tax profit margin has grown over the last 5 years, but is up even more over the last 7 years. Return on equity is in an uptrend. The company has some debt, a little bit more than I like. It's about 40%, but if compared to the managed healthcare group, medical managed healthcare group, it is comparable. If you look at value, not a value line, but also Yahoo, you will see that. And it is classified by the GICS, or the Global Industry Classification System, in the managed healthcare sub-industry, which has things like Cigna. So it has a lot of large companies for you to compare it with. Next slide. As shown here, it is in the healthcare section, healthcare plans. It is considered a large cap by sales. It has over $10 billion in sales. They usually provide health insurance plans through the workplace, or usually through standalones, and then negotiate with healthcare providers in the network. Being one of the largest companies, they has given them economies of scale, and they have used it to their advantage. The company has covered about 53 million people by the end of 2023, and it focuses on the insurance side of the business, which provides about 55% of revenues. The Optum is divided into three segments. Health insurance. The Optum Group handles the healthcare delivery services and optimization, and then they have a PBM, the Pharmacy Benefits Manager. Next slide, please. They not only provide insurance for people in the US, they also provide it for a significant amount of people outside of the US. So this is considered a global company. It is also a leader in the employer-sponsored, self-directed, and government-backed insurance plans. So it covers a wide spectrum of the industry. They have continued investments in its Optum franchises, and which they use as a healthcare services colossus that spans everything. So they're vertically integrated as well. Next slide. Because UnitedHealth Group is one of the largest healthcare companies, it's able to negotiate one of the lowest rates with their providers. And that allows them to, in turn, offer lower premiums to their customers. This way of doing business has allowed them to gain market share from their peers and allowed this company to become very dominant. However, due to multiple uncertainties in the current business environment, from Medicare as well as from the cyber attack, which we'll talk about a little bit later, and regulatory probes due to the opioid issue, so they have been facing a couple of headwinds on the business front. And it's not only them. The stock price has suffered. Next slide. Their debt to capital is well below the industry average at about 10.2. Its prescription delivery service operates as a subsidiary, has agreed to pay $20 million to settle allegations of illegally filling opioid prescriptions. This is one of the current issues that is affecting the company. The company has also agreed to purchase another company, and they have also started divesting parts of the companies to, how should I say this, to prevent the feds, the SEC, from coming after them for, being a monopoly. So they have, between them and the company they're looking to purchase, they have started divesting certain assets to be in compliance with the SEC. Next slide. The company is planning on revealing its latest earnings on July 16th of this month. They do pay a dividend, and it's on the low side. They pay about 30 to 31% of their earnings out as a dividend, which, based on the industry standard, allows them room to grow even if the share price does not grow. So they are in a good position to continue to grow their dividend. However, for the most recent quarter, sales has continued to grow, but earnings and pre-tax profit has suffered. And this is because of the headwinds facing the company with the opioid litigation and divesting parts of the company to be in compliance with the SEC, along with some other items. Next slide. The company's integrated strategy has given it some of the best returns within the industry. And They grow also not only organically, but they grow by mergers. As you can see, in 2018, they picked up parts of CVS Health. They added Aetna's medical insurance assets and retail stores and market-leading pharmacy benefits managers and Cigna. They added Express Scripts, pharmacy benefit manager assets. So they have strategically picked up assets that allow them to grow organically and basically have given them a significant advantage over their competitors. Next slide. UnitedHealth has demonstrated an uncanny ability to remain at the leading edge of the changes that are affecting their market. For example, the 2015 acquisition of Catamaran, which greatly increased their PBM scales, and subsequent acquisitions, again, like I discussed a few minutes ago, from CVS and other parts, other pieces of other companies within their industry. So they have used this not only to grow the company by acquisitions, but to also be accretive to the company in subsequent years and allow them to provide low-cost products or lower-cost products to their consumers, which allow them to continue to take market share from existing competitors or peers, and allow them to vertically stack the company so that they can cross-sell a lot of products to their customers. Next slide. As I just indicated, by providing the diverse yet connected services, it allowed them to vertically integrate the products that they provided to their existing customers and allow them to use that to make the company more competitive in the long run. They are facing some regulatory scenarios, and we will talk about that in a few minutes. Specifically, I like how Morningstar has laid that out. Next slide. So in reading the Value Line and Morningstar, Value Line, while they like the company, they recognize that they are a top quality company. They don't find this company as appealing going forward for the next 3 to 5 years. So the dividend is well covered, but they're thinking that if you want to enter this company, it might be best for you to wait for a pullback for a better entry point. And this came out in May of 2024, May 31st. Next slide. Morningstar, however, continues to like this company. They like how the company has advanced, and they like how they have vertically integrated a lot of their products to give them a competitive advantage, to allow them to take market share from existing competitors or peers. Next slide. The disadvantage is, as with everything else, economic downturns could cut into their near-term earnings. The insurance and the pharmacy benefit manager industries are targets of regulators, especially seeing in this inflationary period that premiums have gone up significantly and coverage has kind of reduced. And also they think eventually the law of large numbers will or probably catch up with these companies, which will take it down to the more consistent growth rates that a large cap company based on BI's philosophy will continue to as far as that will grow at maybe about 7%, not necessarily 10%. Next slide. So in summary, the issues that affect this company would be healthcare policy changes, Medicare changes. It is a company in the top echelon of the healthcare services, and they have right now a very impressive leadership team that has shepherded this company to the forefront of this industry. As long as they continue to pay these people, I think they may continue to enjoy that #1 spot. But as with everything else, we know competitors usually are lurking at your heels. Next slide. Okay. The SSG is also been provided as an attachment for you to take a look at and to tweak as you see fit so that you can take a look. Right now, I do have this company in the hold range. If it pulls back a little bit more, I think it will be one of the companies that I will be adding to my portfolio. Thank you very much. This is the end of my presentation.
Thank you, Susan. And last but certainly not least, Ed Rodriguez. Ed has been one of our regulars, but we haven't had him in a long, long time. So welcome back, Ed. And you have a really interesting presentation about Palo Alto Network. So I'm looking forward to hearing it. So go ahead, Ed.
Great. Good evening, everyone. As Kevin mentioned, I'm doing Palo Alto. A little bit of background. I did this same company back in digging into the BI presentation back in November 23. Since then, there's other ways you could have identified this company, and that is it was BI's biggest mover within the top 200 this past year from 2023 to 2024. So a lot of interest in this company. Next slide, please. So I'm sure most people are not really well acquainted. So some of these slides are similar to what I provided back in November, but it bears worth a little bit of a reminder. Palo Alto is basically an enterprise cybersecurity company. It provides a very broad range of security services, ranging from network security, cloud, endpoint. It helps you monitor your operations center. Its revenues are about $2 billion. Its bookings are a little bit more than that. Again, using BI criteria, this puts it as a medium-sized company. Even though it is basically the industry leader for as far as revenue in this area. And we'll talk a little bit more about that later. It's fairly large. It has about 14,000 employees. And importantly, it has a lot of customers in a lot of countries, and a lot of them are part of the top companies in the world. Next. So this gives a little bit more flavor to the concept of cybersecurity. The thing I want really people to come away with is that this is a very broad, diverse field where the different types of security services that are needed and therefore provided by companies like Palo Alto are really broad, very diverse. They focus in on applications, on encryption, how do you log on to your network. So there's a lot of different things that enterprises are looking to basically secure, and it's quite the challenge. Next slide. As far as what Palo Alto does specifically, they're organized in a few ways, mostly around 3 platforms. You see at the top there, one of the platforms basically deals with cloud security. Lower left, we're dealing with network security. And then the third area, it has to do with operations. And what that means is, you know, you have all these components in your enterprise that are monitoring security. Well, boy, there's thousands of devices out there. What do you pay attention to? So this is generally considered, it's categorized as security operations type of services. Generally, it's people with tools that monitor what's going on. And lastly, and there was a recent article in the paper about They're Unit 42. These are humans that are white hats that are experts in cybersecurity. And when you have a bad thing happen to your enterprise, they get brought in to do forensic analysis. So not a huge part of their overall revenue, but an important thing that helps to be an entry into companies that are potential future customers. Next. So how is Palo Alto different? I'd like to actually, can we skip this? This was left over from my last presentation. I apologize. What I really wanted to focus in on is just a summary of what in the last presentation I thought were the key elements of what Palo Alto was focusing in on. They talked a lot about a zero trust framework. This is a framework that is documented in the federal government. There's a push in terms of implementing enterprise-wide security in a manner so that you don't rely on trusting any one component, and it's intended to give you a lot more resiliency in terms of security throughout the enterprise. The other thing, and they're not unique in this respect, and that was best of breed solution. Remember earlier I mentioned that there's a lot of different products out there that are needed in the enterprise. And so for each class of those solutions, you can evaluate them and you could say, hey, within a firewall, this is the very best firewall. And so a lot of Palo Alto's focus has been on accumulating a set of solutions that are best of breed. Now, not everything that they provide is best of breed, but that's been generally their focus. We'll talk a little bit about that maybe being a strategy that is no longer in play, but let's hold off on that for a minute. Next thing is that the focus also is on large deal momentum. Clearly, what they want to do is sell a lot of product to an individual customer. This is no different than most companies, but again, they have put a lot of effort into this. We'll see their latest take on this a little bit later. The way they've grown this buy and build strategy basically is either going to build it myself with internal developers and create these tools, or I'm going to buy a tool out there that I think goes well with my existing set of tools. And so that's been their long-term strategy for growing over the years. I think we're going to see a shift away from that. And again, we'll talk a little bit more about it. And then lastly, something that I think is still in play, and that is the cyber market is big. It's getting bigger, and it's getting bigger at a quicker pace, at a pretty good pace, 12.3 over 2030. Next slide, please. So back in November, what were the analysts thinking? So there's three things in this slide and that I want to focus in on. One is this concept of they are considered to have a wide economic moat. Real briefly, for those that don't know what an economic moat is, it is capabilities that you have within your company that make it difficult for a company to move away or to change and drop you as a customer and move to someone else. The wider the moat, the better and the more difficult it is for a customer to move away from you. The second thing is, even back in November, there was a sense of uncertainty being high with this stock. I think you're going to see some evidence of that being somewhat prophetic. The third item is the valuation back then was pretty expensive, and we'll use the PE ratio for that metric, and that was, I think it was up above 100. The bottom line is, when you have a PE that high, and this is for any company, you don't have much room for error. And sadly, we're going to go into what that Palo Alto actually did encounter some problems. Next slide, please. So also with the core SSG, just a few slides out of that part of the presentation. One is, this is not a classic better investing stock. The charts, the graphs are ugly. They're not straight and up to the right, like railroad tracks. The second thing is, and this reemphasizes something I mentioned a few minutes ago, and that is they had been incurring a lot of debt by acquisition to bring in products into their company that they can offer as a suite of tools to their customers. And the last thing was the estimates that are shown there were pretty lofty. At the time, they seemed like to be good estimates. There's certainly a little bit of hiccups that were encountered since November. Next slide. So what happened? So as you can see down in November, we saw price down around 240. Now it's at 340, but the journey has been a pretty brutal one. And in fact, back in February, the company underwent a pretty huge unexpected pivot. So with pun intended, let's dig a little bit into that. Next slide. So the big thing back in February is that the company announced a change in strategy. And what they want to do is they want to move away from selling individual products to something that they call platformization, which is, hey, I want to sell you, my customer, not just one tool, one platform, but I want to sell you all three of my platforms. And this is somewhat of an appealing, I think it's actually a very good strategy. And part of the rationale for it is that most companies have like over 100 products in their enterprise. And along with those products, many different vendors. So this is a pretty big burden in terms of management. The platformization, as I mentioned, is let's switch over. We want you to be on each of our three platforms. Part of this initiative of this implementing this strategy is that they've met with 900 of their top 5,000 customers to convince them, and they've shown. I don't get into details yet, but they've shown some success in actually selling to some of those large customers some very large orders that include all three of their platforms. The other thing they did, I thought was pretty savvy, and that is they sponsored an IDC report. IDC is one of these companies that will go out and analyze things in the IT space. And what this report comes back and says is it doesn't focus in on the technology or the security attributes of tools. It focuses in on the business case of this strategy. Hey, we give you three platforms. You could do everything from here. It's a much more efficient way, and we can show that you're going to get a good, strong return on investment by adapting this sort of strategy. Next slide, please. So I thought real quickly I'd show graphically what we're talking about here. On the left side, the current state is typically an enterprise will have different tools providing different security services from different vendors. And so these things have undergone integration, and they're kind of typically pretty fragile. And, if one breaks, it's kind of hard to figure out what the other tool is supposed to do. So what Palo Alto is proposing in to develop a 2 to 3 year cyber security consolidation platform where you, current customer, keep your current tools in place. Over time, you're going to be able to phase out of the contracts that you have for those tools. In parallel, we, Palo Alto, are going to make an investment to set up those kinds of capabilities in our three platforms. And as over time, we migrate over to the right side, which is those tools kind of are deprecated. The customer doesn't renew their contracts, and now they go with the Palo Alto suite. So I just thought I'd show this because this is a very powerful thing. And frankly, in short, if you're going to invest in Palo Alto going forward, you got to understand this strategy, and you got to really believe in it. Next slide. So other headwinds, there are macro factors, some big delays in their earnings call. They talked about the federal government kind of being delayed, and they're not getting some of the revenues they anticipated. They're also funding some of this so that they're kind of like some of the pay me in 30 days type of service. Well, here they're actually offering the customer to pay them in a delayed manner, kind of over time. And with that comes some possible issues in terms of default payments and things of that sort. And let's not forget, Morningstar was absolutely accurate with their high uncertainty rating, and that hasn't changed going forward. On the other hand, there are also some headwinds that are going to help. Their margins continue to improve, cash flow is improving, return on invested capital improves. The other thing is that they talked about having implementing AI, and frankly, I think that was a little bit of hand waving. But one of the key things to really provide effective AI services is having a lot of data. Palo Alto, being one of the biggest vendors out there, has a lot of data, so I think that's a pretty positive thing. At the earnings call, they also talked about this buyer's fatigue, and hence why I think they're appropriately kind of pivoting and focusing in on return on investment to help that buyer understand what is their investment going to get them. Lastly, they've also included a deal recently with IBM to buy their security operations center business and replace it with, over time, replace it with the comparable Palo Alto tool. Also, that gives Palo Alto several thousand cyber engineers to sort of help sell their product to existing IBM customers. Next slide.
3 minutes, Ed.
Thank you. So here, and I apologize, I left out one of my bubbles here, but so when I look at low price, for those that remember, one of my pet peeves is, how to establish these low prices for the SSG analysis. My personal preference is to use technical analysis. Over the last year, there are 2 levels of support. One at 262, which is shown there with the bubble. Not shown, the price at the bottom there is 226. So those are 2 possible levels to use for low price when I do my analysis. Next slide. So again, some of the front end of the SSG Plus slides, not a pretty graph. I show some of the numbers there. I want to point out 2 things. One is the earnings percentage being higher than the sales percentage. This is an anomaly based on this company recently being profitable. So when you're at that stage of growth, you'll get that kind of number. As was mentioned in some of the early presentations, generally you want to have that EPS growth be less than your sales. And over time, as the company matures, that'll be the case. A little bit further down, you take a look at some of the management metrics. Generally, those look pretty darn good. Next slide. So as you crank in these numbers, the 54 average high PE has not been discussed. That was extracted from one of the more pessimistic analyst reports that I read. I thought it was reasonable, not just because it came from the analyst, but also it's pretty close to what it's been at over the last number of months. And I don't think you're going to see a really high PE like you did a few years ago at 100 going forward. So this felt reasonable to me. And as I mentioned, I used my low price selected based on technical analysis. And so there's a calculated price that I selected and discussed at 226. Next slide. So when you crank up the numbers, this is where we're at. We have a 4.4 to 1 ratio, upside downside ratio, a return of about 20%. Next slide, please. So in conclusion, per better investing, metrics, this is a medium-sized company. It is still fast growing, and it was recently profitable. And as I've noted, because of those graphs being very non-traditional, this is not your typical BI company. It's well managed, and I think it has a very strong strategic vision that is appropriate for this field of cybersecurity. It's currently a buy at up until that price, and it's a medium to high risk company. This is not for the faint of heart, but this is a growing dynamic field, cybersecurity, and I think that this is a strategy that I've discussed with you that I believe in, and so you do your own analysis, but I'm a big believer. Thanks. That's it.
Very good presentation there, Ed. And for those people that were at Bink, Palo Alto Network was mentioned as one of the stock ideas for someone that what they call non-core, a little bit on the friskier side. Susie Artsberger recommended it. And so she's an IT person, so she saw a lot of the same things that you were talking about. Anyway, so what we like to do next is we sort of like to go through and ask all of our presenters. Now, Miriam had to leave because she's also in a class for school at this time. Is we like to ask all of the members who made these presentations to sort of tell us where it fits on this life cycle. So let's go to the next slide, and it'll be a little bit easier to understand. This comes from T. Rowe Price, and he always said that companies are sort of like a human being, that they pass through a life cycle of growth, maturity, and decadence. And so why don't we start with you, Brian, and tell us why you picked that location for Middleby?
Well, Middleby's been around, started in 1888, so it's I'm going to say it's an established company. However, they do a lot of their growth by buying companies and consolidating. So that's why I'm not sure that they're at the mature growth stage yet. I think they still got some kind of in the middle growth. So that's why I did it. And I think that kind of depends on how many soft serve ice cream machines they can sell.
You're fixated on those soft serve ice cream machines. Well, Miriam and I talked about this. CVS has actually been a serial acquirer. I mean, when they started, they also had like Tom McCann shoes, but really about 40 years ago, they moved really more into the healthcare field. And as she was saying, it's a very highly integrated healthcare company with pharmacy benefits, pharmacy stores, as well as now Aetna. So it has a wide range of stuff. So even though it's a big, huge, humongous company, there still is some opportunity for growth going on. And they seem to be doing much better than their principal competitors, Walgreens and even Rite Aid, which is pretty much not even a non-existent anymore. But that's where she sort of put it. Susan, tell us why you have, I just sort of figured that's where you want UnitedHealth Group, but you can tell us if it should be somewhere else. Go ahead, Susan.
Yes, this is a company that is, a very large company. And while, yes, as with CVS, it is still growing, it has a significant number of headwinds that crop up periodically that pulls it down. And also, it has allowed itself to become highly integrated vertically, as well as successfully taking market share. So I think it is a mature company. I think the law of large numbers will eventually catch up to it unless the industry expands significantly in new ways that allows them to continue to grow. If the industry stays in this little box, I think they eventually going to have a portion of the industry, but they have competitors that would allow them that they're going to always be having a little frictionless, competition to get a give and take. So I think it is a large company. It's a company that's going to continue to grow, albeit a little bit slower, as we can see from the SSG provided. So it is in the mature growth phase.
Okay, and Ed, you said you wanted this just a little bit above where it was before, and the first time the star was right about where the PANW was, so I just sort of moved it up per your instructions, so take it away.
Sounds great. Yeah, so I think there's still a lot of potential for growth with Palo Alto, and the main thing that I would cite is that cybersecurity is a very fragmented field. So even though Palo Alto is currently the largest company there, they still have a very small percentage of the TAM, the total addressable market, for the types of tools that they're offering. So if their strategy is successful, I think that they'll bring in some customers, and as I mentioned before, their wide moat is gonna allow them to keep those customers, and so you can see some good growth, in years to come. That's it.
Thank you very much. Well, we went through all of this, and again, we had a really nice crowd here tonight. Let's go to the next slide, Cheryl. And I think it's time for everyone to vote. It's not necessarily the one that you think is a buy, but which one intrigues you enough that you want to do some additional research. We're not giving you buy, sell, and recommendations, even though we contributed, but go ahead and release the poll and let everyone vote. They've been sitting around long enough. They should probably want to hear what's going on. So the poll's been released, and go ahead and start voting. Things are moving really fast. About 30% of you have voted. Let's see if we can get up. Well, we're at 40. Let's see if we can get up over, we're almost up to 50. Generally, we get up around 70 to 80%. So if we haven't bored you, you guys should still be, and gals, should still be wanting to vote. Inching up a little bit more. Boy, it's sort of slowing off. Let's see if we can get a couple more votes. Just at about 53, 56. Let's see if, can we get over 60, even up to 65? We're at 58. Come on, give me a couple more votes. 2 more votes should get us over 65. Come on, you know you want to vote. You really do. It's stopping. Let's go ahead and really, only 60% of you voted. And go ahead and share and let them see who the big winner is. Ed, you are the big winner. So that means you get the prize of being able to do a presentation next month. Congratulations.
There's some static on the line, Kevin.
Ed, always glad to have you, and thank you very much. While we're doing that, let's take a look. We did have a couple questions, only one. Actually, Bakala was mentioning when Miriam was making her presentation. Yeah, the cost of that was going on for that, which I think she said like 69 million. She meant to say 69 billion, and yeah, you had 70 billion on there. So yeah, that was a massive operation that's going on. If any of you have any questions for any of the presenters, go ahead and raise your hand, and we will release things for you so that you can be able to speak. We've gone several months where everyone's been really, really quiet, and now it's just like we had 1 or 2 months where people were talking. No one else is really sort of jumping up. Come on. You spent all this time putting it together. Let them show off all their knowledge. Anyone? Anyone? Bueller? I don't see anyone doing it. All right, let's go to our next slide. If you're shy, I'll take a look at it a little bit later. Let's continue through this.
I also want to interrupt you for a second, Kevin. Please do the handouts now because they do not transfer into YouTube.
Yes, we do not put them up on YouTube. So if you have any additional questions, you can reach the Digging Into the BI contact that several of us have access to. Or if you need to be able to reach either the DC regional or the Maryland chapter, there they are. There's a picture of many of us that have done the presentations that we were all at BINC. In fact, several of them I see are in the audience with us tonight. So thank you very, very much. Glad to have you as always. And the like, and some of the ones that aren't here are going to be presenting next month. So we pretty much got the whole shebang going on here. But again, the only reason why this has been a success is because we've had so many different people help out. Like I said, Miriam was the 35th different person ever, and we've actually had like 23 different people so far this year. So kudos to all of you that have helped out. As they say, a success is many parents and a failure is an orphan. So we have many, many parents to thank. Next slide.
We also, if you have a club out there and you would like to advertise your club, come and be a presenter, and then you can tell us all about your club.
And show them you know how to do the SSG so that you can be able to work with them. So again, make sure you're on our mailing list. Carol does a wonderful job of getting everything on out. You don't have to be a member of the DC regional chapter. You don't even have to be a BI member. It's just a way to be able to connect with everyone, to be able to let you know what we do as a long-term fundamental investors. And again, the URL is at the top of all of these here. Let's go to our next slide. Kent isn't here, but he normally will tell you all about all the great things you can do as volunteers. All of us that have been doing this are volunteers. They're the heartbeat of better investing, and I see several people that I met at BINC that are directors in other chapters outside this area, and they will tell you about that too. This is a great way to learn more about investing. If you're hanging around with people like this, learn new skills. And again, if you need help doing some of these presentations, sometimes people are a little cautious, they don't feel confident enough to do a presentation, we will help you either with if you have trouble just doing the SSG, or if you know having trouble putting together a slide deck, we can help you with that too. That's what we're here for. And as a director, you do get some discounts, so keep that in mind. Anyway, let's go to our next slide. So next month, we already have our two featured stocks. The stock to study is FedEx, and the undervalued feature is the Gap. We have two more that are to be determined. In fact, we're still looking for a to be determined. We need one more presenter for August. So if you've been kind of shy, we certainly have some people who can help you out, and you'd be able to pick your own stock. But those are the things we're going to be doing on August 5th, the first Monday in August, and starting at 7. Next slide. So we also keep it up on Manifest Dashboard, sort of a tracking portfolio, so you can see what's going on. If you have any questions with it, you don't have to be a BI member, because if you go to the next slide and you download these handouts, you get the hyperlinks to all of those locations, so you can be able to drop them and take a look at it. They're all public dashboards, so you can sort of see how they've been performing since they were initially presented. Next slide. Well, that's all from us. Let's take one last look and see if there are any more questions. But this last one that underlined, that's a hyperlink to the YouTube channel, Digging into BI. I don't see, do we have any more? Yeah, Laura, thank you very much for the comment on the YouTube channel. Yes, it's we've gotten, I've noticed a little uptick in the number of people that have subscribed to it. So that probably was your doing. But thank you very much, Laura. We appreciate that. Any other questions? Anyone? Let me take one last look and see if there's anyone that has their hands up. Oh, Bakula. Oops, did I do that right? No, I missed it. Bakula, I'm going to unmute you. It looked like you had a question, so I have you unmuted. So if you want to be able to say something, go ahead.
Thank you. Can you guys hear me?
Yes.
Yeah, so the Palo network, I think it's a great presentation by Ed. What I noticed, I think because of the growth mode, the earlier years, they didn't make any profits, but the most recent years, they showed a profit in 2023. But it's operating cash. If one would look at the cash flow statement, a big chunk of the operating cash is generated by stock-based compensation. And so, that's typical of technology companies, and you just have to, over time, monitor if that increases over time or stays steady. Because you want the operating cash by its sales and revenue generation versus, versus stock-based compensation. So anyway, that's my thought.
Very good. No, I know you love to be able to look at those. You really dig into those financial statements, so it's always good to hear your insight on that. So thank you very much.
You're welcome.
Anyone?
Yeah, and if I can add something, I could just tack onto that. So that's a great observation regarding a very specific metric. And, with the BI, there's certain metrics that they kind of monitor and don't. One of the things that, and I didn't get into it at all, is, with these kinds of companies that are sort of like software as a service, there's a whole bunch of other metrics too that if you're going to be investing in these companies that you want to become comfortable with and monitor them, in addition to some of the more hardcore fundamental metrics that was just discussed as far as stock-based compensation. So just wanted to add a little bit of color and to that great comment that was just made. Thank you.
Ed, do you want to give us a couple examples of things you would look at that are beyond the SSG in terms of metrics that we would look at for someone like a cybersecurity company?
Well, I wouldn't make it just for cyber, but more like the software as a service. So one of the things that the Palo Alto folks have done in their last few earnings is emphasize a metric called, and I'm going to my notes here, RPO, which is remaining performance obligation. And, the thing is with subscriptions, you want to be able to have some insight into future earnings that you're expecting to get or future revenue you're supposed to get that you just can't book right away. In fact, if you try to book it right away, you become maybe a little bit like Enron, which is where they got in trouble. But so this RPO is something that at least Palo Alto is emphasizing a lot in terms of to the analysts to, hey, if you really want to see how well we're doing, take a look at that metric as well in regards to, our health and our growth and, how we're doing, particularly since so much of our business is subscription based. So that one kind of caught my eye, and there's a whole bunch of other ones, but that one in particular because Palo Alto emphasizes that in their earnings reports that they've released over the last few quarters.
Very good. Bakul, do you have any others that you would look at? Because I know you look at this industry quite a bit.
Yeah, so in addition to what Ed was saying, when we look at debt to capital, one has to kind of look at it a little carefully, particularly with software service companies because they are subscription based. So what really happens, they like the business model is like newspapers, right? So if suppose you were a subscriber for a newspaper and you pay 1 year's worth of renewal, the company can't, the company hasn't provided the entire year's worth of newspapers to you. So what they do is like for the first month, they'll book the cash, and for the remaining 11 months, what they'll do is they'll say deferred revenue, and they'll put it on the liability side of the balance sheet. So in the case of Palo Alto Networks, if you look at the total liabilities, it shows 12.7 billion. But you dig into that a little bit, you'll see that the current liabilities, in other words, the deferred revenue that's due within 1 year is 4.6 billion compared to the 12 billion of total liabilities. And then they also have long-term deferred revenue for another 4.6 billion. So essentially, those are monies coming in the future. Almost like $9.2 billion of future revenue that's showing on the liability side relative to the total liabilities, 12.7 billion. And so one might have to say, okay, how do I kind of, crack this nut? And essentially, they're not really liabilities. They're just telling you that, hey, we got future revenue coming in, but we've collected the cash already. That's what he means.
Okay, very, very good. I appreciate that. Any other questions from other folks?
It's kind of like an accounts payable, if you were looking like in an accounting firm. So
it's actually receivables.
I mean receivable. Thank you.
Yes. And some companies, like if it's Coca-Cola or it's not Coca-Cola, I don't remember one of the companies, or actually there's quite a few. Some of them actually even finance their receivables through insurance companies. That's really aggressive accounting, but I don't think this company would do that kind of thing.
Okay, very, very good. Well, thank you very much. That was very helpful. Any other questions from other folks? If not, we will let you go. Thank you very much. Come join us next month when we'll, again, on August 5th, we will dig into the latest issue of BI and have 4 more fine presentations for you. So thank you very much for being here. Please make sure to download those handouts. You can share them with your friends. Thank you, Laura, for spreading the word down in Florida. We appreciate that. Good night, all.
Okay. Bye, everybody. Thanks, Kevin.
Good night.
Good night, Susan.
Good night, Susan.
Good night, Jim Boy.
I knew that was coming. We're down to, I think, 17 people. So I guess we can probably shut it down.
Okay, I hope that was helpful to you, kind of jumping in there when I heard it go quiet.
Yeah, no, it was because I actually had muted myself. That's the reason. I was like, oh, damn, I'm talking and no one's listening to me. I'm muted. We all do it.
Oh, we do.
All right.
That's why I'm laughing, because we all do it. Good night, Kevin.
Good night.